And so the question for today is, how do we read the U.S. economy now? Right? What's happened since we gathered in this room a year ago? And I want to suggest if you read the headlines, it's not hard to tell. In fact, let me jump to the next one. This is the greatest economy in the history of the country, the administration would have us believe. And the two headline numbers that are talked about most are stock prices and the unemployment rate. One of my slides is already out of date. I dared to put a slide with the stock market closing price high that happened on Friday, of course, and it's already been vested. And so that's to say stock prices are at an all-time high. And some might say, well, this is a sign that aren't markets really good aggregators of information? Don't they do a really good job of predicting what the growth outlook is? And if we expect growth tomorrow, don't stock prices go up today? Well, under normal circumstances, under ideal circumstances, let me put it that way, theoretically that should be true, right? And actually I'll also concede we are big market advocates. We have helped build an environmental market. Generally speaking, we think markets are less awful than almost any other way of coordinating an economy. And so you might think, well, the S&P tells us the outlook is strong. The other one's unemployment. We hit 3.6%, all right, a 60-year low in the unemployment rate. And so looking at these numbers, you might think, wow, the outlook is really, really strong. How about stock prices? So this one, again, if you're a firm believer in markets, there's every reason to think that the next year's one-year outlook is great because the S&P hit an all-time high yesterday. I haven't checked today. There could be a new one as we speak. But I also want to argue that in the same way that the unemployment rate is disconnected from fundamentals in the labor market, stock prices are disconnected from fundamentals in the macroeconomy. And this is just one headline. I have 6 of these, right? I won't bore you with all 6. I collected 6 of these during different months of the last year, and the headline's the same. U.S. stocks continue rally after jobs data. What do you think the subhead is here? What happened to labor market data that caused a surge in stock prices? Well, the Dow rose 300 as lackluster job report was released. Right? I can show you examples during the last year where the stock market rallied on bad economic news. And the flip side, when news came out really strong, stock prices contracted. Right? Stock prices are disconnected from fundamentals. The explanation here is that, frankly, the Federal Reserve has sort of broken the machine. Right? We are in a period of ultra-low interest rates. They've now done 3 consecutive interest rate cuts during an expansionary phase of the economy. We never got anywhere near the historic short-term interest rate average of over 5%. And it's the ultra-low interest rate environment that is driving people into stocks. And stock prices are not necessarily a forecast of what we can expect in economic activity in the year ahead. Here's more evidence. Let's assess the market. Wednesday, October 3rd, Chairman Powell had a press conference, and he announced to the U.S. that the Federal Reserve was going to undertake a normalization of policy. They were going to increase the short-term interest rate 25 basis points, and that they planned a series of incremental increases in the short-term rate. What happened? In a matter of minutes, the market shed 800 points, and over a period of weeks, we were down 19.7%. So I ask you, does a healthy stock market lose 20% of its value on a 25 basis point increase in short-term interest rates? The answer is obviously no. All right? A strong, healthy market, a strong, healthy economy shrugs off a 25 basis point move in interest rates. And so this tells us that there's a fundamental disconnect, again, between stock prices and the broader economy. What it tells me, I think, is that probably about 25% of people in stocks don't belong there. Right? They're not there because they're interested in investing in stocks. They're chasing yield. Short-term interest rates means you can't find yield anywhere else in the economy, and so they'll go into riskier and riskier assets to find it. And so a normalization of policy obviously would correspond, a return to a normal monetary policy regime would correspond to about a 20% decline in stock valuation. Of course, we know on January 5th, right? My wife and I actually do have some money in an S&P fund, right? These were dark days in the Fienup household. On January 4th, my wife cheered when Powell said, "I didn't mean it. I take it back." In fact, we're going to cut interest rates, and the market was off to the races. In fact, we are now up 32% from the policy reversal, and all-time highs as recently as maybe right now. So this is our view. We're very sympathetic to this. Congratulations, market. The Fed is officially at your mercy. At the event in San Diego where we presented the Latino GDP report, former Treasury Secretary David Stockman actually coined a phrase we wish we had. Dan and I had first. He said, the Fed is now a wholly owned subsidiary of the market. And we're very sympathetic to that.